The man who infamously predicted the 2008 financial crisis, Michael Burry, is back at it again just yesterday, tweeting out a terrifying one-word warning to investors. Sell. Following this, Burry went on in classic Michael Burry fashion and completely deleted his account, going ghost mode protocol once again. Now, of course, this sent investors and financial media into complete panic mode. The question on everyone's mind: what does he mean? Is he joking? Is he serious? However, as someone who's been following Burry and his cryptic tweets for years, I knew exactly what he meant and was referring to when he tweeted out his warning, and unfortunately, Burry's tweet couldn't be anything further from a joke at all. On the contrary, Burry believes there is much more pain to come for the stock market, crypto markets, and real estate markets, and a deep recession is awaiting us in 2023, and it has everything to do with the Federal Reserve's decision just today to only raise interest rates a further 0.25 basis points, a mistake Burry believes will be catastrophic for markets in the future. In this video, I will break down every cryptic clue that Burry has left leading up to his final sell tweet, and the 3 top reasons why Burry is so bearish on everything heading into 2023. But before we jump into the video, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free, helps out the channel a lot, and you can always change your mind. So first things first, how do we know that Michael Burry is even serious about his tweet? The last time he issued a warning, tweeting out, "You have no idea how short I am," it turned out to be a joke, with him later tweeting out, "I am not short," and then going on to make a joke about how he is actually 6 feet tall. Well, we just need to look back into his tweets of 2022, where he makes a clear-cut prediction for 2023 and how he thinks markets are going to play out, to know that Michael Burry is definitely not joking this time. Here, in a nutshell, is how Burry believes 2023 will play out for investors. What strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended multi-year recession. Who is predicting this? There are none. Now that we know that Burry isn't joking around, let's jump right into it and address the elephant in the room: inflation. And Burry has some extremely polarizing views when it comes to inflation and how it will affect markets in 2023. Looking back on Michael Burry's inflation prediction in 2021, he was a big believer that we were going to get crunched by inflation in 2022, and as is common the case, he was spot on in that prediction. Burry tweeted out in 2021, "The US government is inviting inflation with trillions of money printing plus reopening boosting demand as employee and supply chain costs skyrocket." And as we saw play out in 2022, inflation was way higher than markets predicted, which caused the Federal Reserve to go extremely hard on monetary tightening and raising interest rates at an unprecedented speed, which had the effect of wrecking asset prices and stock markets globally. And for 2023, Michael Burry doesn't think the pain is over. Burry believes that markets have not yet bottomed because he believes we're going to see another huge spike in inflation like we saw in 1929 and the 1940s. Predicting for 2023, Burry tweeted, "Inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell. It will be because that is the essence, the nature of inflation. It resolves, fools people, and then comes back. When it comes back, neither the President of the United States nor the Fed will take credit." And the charts back up Burry completely. They show that since 1940, inflation does not occur once, but usually spikes twice before eventually resolving. This isn't a trend that has only been spotted by Burry either. Tech billionaire and investor Chamath Palihapitiya has spotted this and spoke on how the sharpest minds on Wall Street are expecting this exact scenario to play out in 2023 too. So, a double spike in inflation causing more downwards pressure on markets and forcing the hand of the Fed to continue to raise interest rates and tighten their monetary policy is Burry's prediction for 2023, which can only mean one thing: lower equity prices and a lower stock market. And we are already seeing this prediction play out in markets. Just today at the Federal Reserve's FOMC meeting, they announced they are going to slow down their rate hikes and only hike by 0.25 basis points, a slowdown on all other increases. Jerome Powell spoke on how they are already seeing signs of disinflation and that they will continue to slow down rate hikes in the future. However, this situation is exactly what Burry is warning of: the Federal Reserve slowing down rate hikes too early and too fast, which makes the market rejoice and go back upwards, which is exactly what we saw following the meeting. Both stock markets and crypto markets jumped significantly upwards following the announcement. Historically, when this occurs, inflation comes back more pernicious and worse than before, which will crush markets, which is exactly what Burry is afraid of. Now, this leads us on to Burry's second prediction for 2023. Continued interest rate rises from the Federal Reserve to battle the second round of sky-high inflation. Although inflation does look like it's coming down and the Fed is hinting that it will pivot in the near future, as we covered before, Burry believes that inflation will slow, causing the Fed to reverse course and cut interest rates, only for inflation to peak harder, and this caused the Fed to have to continue to raise interest rates. Burry tweeted about this after Business Insider covered his initial prediction that inflation will slow, only to double peak. You heard it here first, or second, or third. Now, Burry's third prediction going into 2023 is that any market rallies we see in markets are going to fool investors into thinking that the bottom is in. In a tweet, Michael Burry warned investors that dead cat bounces are the most epic and can easily deceive investors into thinking that the bottom is in. 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. He also shares the Dow had 10 bear market rallies of over 10% and averaging 22.8% before going on to bottom a further 89% down. Therefore, he's suggesting that investors should not be fooled. It will take some time before hitting the true bottom of this current downturn. But what indicators is Burry personally watching to judge whether markets have truly bottomed or not? Well, Burry has also shared the indicators he is currently watching. The first indicator is a reading of the VIX, which refers to the stock market's volatility index. The higher the VIX, the more volatile the market, and vice versa. Historically speaking, there has been no bear market bottom without a VIX reading of 45 or more. Recent history has proved this rule as well, with the market not bottoming until huge spikes in the VIX was observed, with readings of 70 in the 2008 crash and then hitting 65 during the COVID crash in March of 2020. In 2023, we have not seen this huge shoot up in the VIX or volatility, meaning that historically speaking, it's very likely we haven't seen the bottom of markets just yet. The second indicator that Burry is watching closely is valuations of companies. In a tweet, Burry points out that 13% of stocks have closed above their 200-day moving average, which is never usually seen at the absolute bottom. The bottom typically occurs when the number is closer to 2%. At the bottom in 2008, it was 1.2%, and during the crash in 2020, it was at 2.8%. Therefore, according to this metric, we currently still have a fair way to go before reaching the true bottom of markets. Now, the third and final indicator Burry is looking at to determine the bottom of markets is the amount of unprofitable companies on the stock market and their sky-high valuations. Currently, on the US stock market, there are 218 companies with a valuation of over $1 billion that are losing $100 million per year. Additionally, there are 29 companies with a market cap of $10 billion that are losing $100 million annually. These companies include Uber, Snowflake, Lucid, Rivian, and Shopify, among many other dozens of companies. Burry points out in a tweet that before we see the absolute bottom in markets, this silliness in terms of sky-high valuations and unprofitable companies has to go. Okay, so we've determined that Burry doesn't believe that markets have bottomed and will continue downwards in 2023 due to a double spike in inflation, further tightening from the Federal Reserve, and increased interest rates across the board. But how is he personally positioning his portfolio to weather the storm and make the most of a bad situation? Well, Burry in a tweet likened the current investing climate to a similar scenario he witnessed play out in 2000. Giving a clue to how he is personally investing. Another feeling I'm getting is mid to late 2000. Free cash flow totally on sale and ignored, while former momentum stocks are coming down but not far enough, and darling, better businesses still had a ways to fall. Value was about to take off for years despite more crash on the way. So Burry is suggesting that boring businesses are the ones that will actually outperform in 2023, which is also backed up by his current holdings as disclosed in his most recent 13F filing. Within the 13F filing, a document which must be submitted to the SEC quarterly and reveals an investor's holdings, it was disclosed that Burry's portfolio has been heavily focused on essential services such as prisons and telecom companies. Currently, 2/3 of Burry's total portfolio consists consists of these real asset companies, whereas in the past it was heavily concentrated in non-essential service companies like Meta or Cigna. It is clear that Burry's significant shift in portfolio is due to his belief that non-essential products and services will continue to decline in value in 2023, while value companies and essential service companies that support the basic functioning of society will become more valuable, or at the very least maintain their value. Typically, in a recession or prolonged bear markets, people's spending habits shift, resulting in less money being spent on non-essential goods and services. This is why technology companies have been particularly hard hit in 2023 and have already begun experiencing mass layoffs with hundreds of thousands of employees being fired. But no matter how bad the economy gets, there are services society will always need to continue to function. Things like energy infrastructure, social services, and prisons, which is why Burry has positioned his portfolio into these types of companies. So there you have it, more doom and gloom on the way as predicted by Burry for 2023. However, he has laid out the blueprint on how to invest in recessions and where to best concentrate your capital. Overall, the main focus for investors in 2023 should be on finding ways to increase their income as much as possible over the next 12 to 24 months. This way, even if the market continues to decline, they will have sufficient cash on hand to take advantage of lower prices no matter the assets they decide to invest in. Anyway guys, hope you enjoyed today's coverage of Michael Burry. If you enjoyed the video, consider subscribing or leaving a like, it would be greatly appreciated. Leave a comment on what investor you would like covered next, and as always, all the best.